All right, welcome everyone. Today I'm super excited to introduce Hunter. For those of you that don't know, I think, by the way, Hunter, I think I saw you have over like 800,000 followers right now on LinkedIn. So you definitely have like the zeitgeist of the early stage movement. But Hunter's a partner at Homebrew. Homebrew has been going since 2013, investing in seed stage founders all over the world. He's also backing new firms via Screendoor. It's a new type of LP and previously to being an investor, Hunter led consumer product management at YouTube. Also helped launch AdSense as part of Google. Hunter, thanks for joining.
Thanks, Mike. I have to uh, dispel maybe, your admiration of my thought leadership. So LinkedIn is the only, sort of follower network where I did benefit from a dark pattern. A while back, they were doing like an influencer network sort of thing. And I
Mm,
wasn't part of the first wave of like suggested follows. That was, I think, more like Richard Branson. But, I was part of the second wave. So I would say some percentage of that is earned and some percentage of that is unearned. But, I'll take it.
well, I appreciate your truthfulness with that. So this whole kind of series in for me kicked off in this year when thinking about secondaries and you've written about secondaries, and I think part of that fascination for me is that how it affects both our customers, both founders and investors. And uh, like we when we kicked off, Homebrew was started in 2013. What surprised you about how the seed stage has changed in the past 12 years, and what's really changed and caught you by
Yeah.
surprise?
Look, to put it into context, I think seed stage used to be this sort of protected class. It was different than other rounds of venture. And now it's frankly, not that different. And you still have a bunch of seed stage firms that are maybe grappling with that. And what I mean by not that different is m- a lot of the same firms that would invest in A's, B's, and C's and beyond have robust seed practices. And even if they say they don't, they will take the best quote unquote seed rounds and turn them into A's by, writing 6, 7, 10, $12 million checks, skipping seed. 2013, we thought that being able to put money against kind of the sweat and reputation we wanted to deliver to founders was sort of the bundle. And I think that bundle has been broken up, frankly. Large firms can put checks against these almost as option value, and then the founders can fill out the rest of their cap table with smaller funds, with operator angels to get the help that they might need. And that unbundling of kind of, let's call it like, counsel and capital has led to, I think, incredible competition for consensus seed rounds within the ecosystem. Maybe to founders' benefits. I don't think always to sort of venture or venture LPs benefit.
And so part of this was, I think it was 2022. Homebrew decided, hey, we are not going to raise outside capital from LPs. We're going to use our own capital. Can you walk me through that decision and like, and so like how does the math work, right? So it sounds like it's competitive. So
The math
yeah,
is
I
really the
guess
math is really bad on making that decision.
okay.
Don't do it if you like money. Don't do it if you like money. No, so look, Sach and I had started Homebrew with a few kind of core principles, and those would be that we didn't necessarily want to grow the firm dramatically in terms of adding other partners, increasing, sort of assets under management dramatically, for reasons both of simplicity. We wanted to spend most of our time just focused working on founders. Everything else we felt like was a distraction from the work we loved, and that we also felt at the earliest stages of companies. Putting too much of an operations team, putting too much capital and your capital needs, putting the venture business model in between the founders and their investors can have implicit and explicit, sort of effects on the type of counsel you give them in terms of your own investment decision making. And we just wanted the purest, answer to what Homebrew invests in would be, founders we love in markets we don't hate, so to speak. And that served us well, for a decade. But we always continued to ask ourselves the question, at what point, if we didn't want to get bigger, even though we loved our small concentrated LP base, maybe it would make sense to sort of really take the risk ourselves and essentially kind of, let's call it self-fund Homebrew. And we decided to do that in 2022, which was, to be honest, a little bit earlier than we had originally kind of, circled a date on the calendar, so to speak. And the reason we chose that, I think, goes to some of the changes in the industry. Maybe we were playing a little bit of offense and a little bit of defense. The offense was We believed after a decade of managing institutional capital that we had the momentum, the experience, and maybe the personal capital base to take the risk ourselves. Most VCs are very, very risk averse and just want to stay the course on a business model that, frankly, you can become quite rich even if you're mediocre. We didn't want to sort of hew to that business model. But maybe the playing defense or reacting a little bit more was we saw a bunch of our peer funds growing size of fund. We were a lead fund, usually would do 10 to 15% ownership, 1 to 2 million of your first 0 to 5. All of a sudden, the math on that became, well, you need 150, 175, 200, 225 million as a fund. And we knew we could raise it. I mean, that wasn't the problem. But the sort of deploying of it became the problem.
Mm.
It sort of violated, in our mind, too many of our first principles in terms of, well, then you all of a sudden you need another investment partner and you need a team and you need to look at areas that are going to deliver alpha and all of a sudden, become interested in those areas almost because there's a herd mentality. And we just want to play that. We didn't want to play that game. We thought it's a self-commoditizing game. Venture firms, venture should be a toolbox with lots of different types of tools, a variety of tools for founders to choose from. When that toolbox is just a bunch of hammers with different colored handles telling you why while their color is the best, best hammer to use, it limits the choices founders have. And so we want it to be a screwdriver maybe in that box. So we self-funded. We ripped up our, looking at the same types of stuff, but we ripped up our portfolio model and we got to say, hey, look, all that really matters is if we want to work with a founder and a founder wants to work with us, we'll figure out how to get a check into a round. We'll figure out how to catalyze a round. We'll figure out how to lead a round, or we'll slip in a check between rounds. And we've made about 50 some odd investments. We've stayed, pretty consistent, 10 to 15 a year. But like I said, the economics are a little bit different, investing your own money versus being paid to invest other people's. But I think we're willing to take that risk, and I think it aligns us with founders even more so.
Is this changing the types of companies that you would fund as well versus if you had institutional capital where hey, we need to return 3x, and so
No, we're
no.
shooting. No, we're still playing a binary outcome kind of game, looking for power laws. We think that's the only way we know how to do technology investing. And so the majority of our investments have continued to be in the spaces that we find most appealing, which have always been kind of applied AI, ML, computer vision, marketplaces, defense tech, fintech, SaaS, that type of stuff. We'll always deviate a little bit. I think we're founder driven. If I was going to say that there was one change that the model drove versus just, what are smart people building these days, I'd say we've probably done a little bit more like cybersecurity, deep tech type of stuff where um, before I'd say, you can't be all things to all people. We were thematic generalists. I think it's really hard to be a true generalist if you're going to lead seed rounds these days. And so those were some areas where just based upon our background, maybe we had interest, but not necessarily expertise. And so previously, if we were looking to lead around and our ownership target, just like everybody else's, sort of almost like always precluded true co-leads, it'd be like, well, why would the best founders in those areas want us to lead that round if we are tourists in it, let's say? Of course, as supporting investors, this line, 2 through 10 on your cap table, we actually know how to add quite a degree of value, alongside other investors who might have the vertical expertise. So I think the relaxing of the ownership target, maybe playing a non-lead role sometimes, has allowed us to, just use our skills against some areas of interest where, sort of strategic understanding of the market space doesn't necessarily have to be the only thing we lead with. But we're still hitting for slugging, not batting percentage. So we're not playing a game of like, oh, we can do things now that before, maybe our LPs wouldn't want to be involved in,
Hmm.
sort of, areas of sin or whatever. And at the same time, we don't play any sort of risk adjusted game, which is like, oh, well, hey, since we're taking all the risk, like 3x, is a good return on your dollars, especially if it's quick. And so let's just invest in these smart kids because they'll probably get, acquired by Meta in a year, whatever. Like I've always found that anytime you believe that your floor is minimally a talent acquisition or minimally your money back, it's not true. Your floor is zero.
Yeah. All right. Fair enough. I love that. And since you've been doing this, I think it's pretty public at this point that timelines have shifted from exit, 7 to 10 years to 10 plus now. What do you think's driving those shifts? And has your choice? Did you see that writing on the wall in 2022 when you changed this model, or is this
I think we
more
saw a
recent?
lot of we saw a lot of writing on the wall. I mean, I think being close to the ecosystem, being sort of, somebody who's been involved with I guess, technology and the venture ecosystem for decades, even if we've only been sort of investors at Homebrew for a while. Um, you know, we were talking about second, where, we're going to get to talking about secondaries, and, we were talking about how I wrote about earlier this year. Like, I was writing about things that we did in 2015, taking money off the table and stuff. It's almost like if you're talking about it now, somebody did it before they started talking about it. So I guess I'd say what we saw with exits was definitely a lengthening. And let's even, maybe let's broaden exit from just, sort of like the IPO or successful M&A to shut down small M&A and then, big M&A IPOs, because all of those are different types of exits that are matter to funds. It's the IPOs, the big M&A that obviously drive returns, but shutdowns and small M&A actually have pretty important roles to play in recycling and reuse of capital. And so what I'd say is over, the difference between 2013, 2015, 2017, and now, although maybe 2025 is turning out, a little bit different, was um, we went through a cycle where uh, there was a high, because of enthusiasm in the market, ZERP, so on and so forth, there was high survivorship, which meant lots of overfunding, lots of rounds, sort of benefit of the doubt rounds as opposed to burden of proof rounds. And so you had companies as a fund that maybe had more cash than momentum and would keep trying to use that cash to figure out how to get something done versus shutting down or returning that to investors so it could be redeployed. Small M&A, especially post-ZERP, also dried up. It used to be you had some of the large guys, larger companies, um, acqui-hiring and actually paying to cap table. Those either became, harder to do from either a regulatory environment and or, if you remember, post 2021, people really collapsed. They were laying off. They weren't bringing in new headcount. And when they were essentially giving people employment agreements and letting them call it an aqua-hire, for the purpose of the tweet. But very little, if anything, was going to the cap table, which again, people sometimes misunderstand in venture, why some of that stuff matters. They think, well, why would a fund like Homebrew want 10 cents on the dollar, as a return? Like that's a zero essentially. And the answer is, well, we never want 10 cents on the dollar if it forces a founder to go work somewhere they don't want to be or to do something unnatural for the company. But we do want 10 cents on the dollar if we can put that 10 cents back into another homebrew investment that will give us 10x and get that 10 cents, get a loss back to be, sort of a 1x return. Like that stuff actually does matter. Um, and so those things all dried up, right? So those things went from frequent, when you talk about length, they went from like frequent and occurring within the first, 2, 3, 4, 5 years of a fund's life cycle to less frequent and delayed. And that has, I think, one of the reasons that secondaries have come into play, and we can talk more about that. And of course, then, where do we make our money? The big outcomes. For a variety of reasons, those got delayed as well. Big company M&A from a regulatory standpoint dried up, although again, fingers crossed, it seems to be a little bit more possible now. And the IPO markets, out of both narrative, companies like Stripe, so on and so forth, choosing to stay private, and out of perception of what the street and what the retail investor wanted, uh, companies would stay private longer, in order to, uh, sort of one, make sure that they were going to come out of the gate strong. And now, it's a chicken and egg argument, and who knows whether the, existence of crossover investors, existence of growth investors were a response to that,
Hmm.
or the presence of late stage capital that previously would have only funded, a structured round, with a ratchet before the IPO occurred, would now be doing 2, 3, 4, 5 rounds of private capital. Those were all, what you might think of as private IPOs in some ways. They usually, involved some secondary for common, some sort of tender offer, maybe some secondary for early investors. And so those were all little kind of pressure release valves on looking for, an ultimate exit that was both kind of economically required and also maybe culturally celebrated. And so, yeah, so now, depending upon the company you're in, you could be looking at everything from, a traditional path to an M&A or IPO, or founders who are building their business and tell you they never want to go private, they never want to go public, and will create different structures to, provide incentive to common and preferred that allows them to do that.
What is that incentive? I'm curious.
It's usually some form of liquidity, right?
Okay.
So it's, putting programs in place that are uh, uh, predictable.
Mhm.
and to uh, whether they're externally set or internally set prices for that company stock that will allow employees to liquidate portions of their holdings periodically. Or it's alongside financings of primary capital doing more and more secondary capital, um, and polling investors for what the current investors for what the demand might look like there. And there's nothing like inherently good or bad about those. Those are all just instruments, but they're instruments that are getting used more frequently. And I think ones where especially early stage funds are uh, you know anticipating being increasingly involved with, or even in some cases looking to accelerate or create their own opportunities for liquidity ahead of the sort of formal options to do so.
One of the themes I've heard quite a bit is your relentlessness of being really founder focused and founder forward. Over the past 12 years, have how's that shifted? Like your approach to founder relationships, like anything that you're more focused on now that you find you're, hey, we're really great here, versus when you first got started.
Oh, that's a great question. Well, I think there always becomes a part in a relationship where you go from being kind of um, we're joined at the hip because you're my lead investor and one of my largest investors, to we're joined at the hip because I trust you, you provide great advice, and I think even when we disagree, you cause me to think, and I know you're advocating on behalf of the company, not your own interests. When we were a lead investor, you hope those things are coupled. You hope that the both happen from day one. But what I'd often find, was during the first 3 to 5 years, as a board member, something like that, we were playing the former role and then earning the right
Mm.
to play the second. So we were your board member, we were fiduciary, we were your VC, and then with enough trust and context, we'd become your sounding board, right? Um, and that usually happened, once you saw what other VCs were really like, and or when just things we were maybe a constant as the world swirled around you, right? So like if you're there early and you're there, you're investing in a company in 2015 and they go through the 2018, 2020, 2021, like there's a lot of swirl, and you're the new people come in, new people leave, there's new types of investors that are interested in the company, they're not interested. We have companies that had three different board members from the same, Series A or Series B firm, due to attrition, replacement, so forth. And so you get to be there the whole time. I think the biggest difference now with our, sort of new strategy, or sort of personal capital strategy is, we have the opportunity to try to do that from day one. Like the idea most of the time isn't that we're your board member, or there's some, sort of hard power because we own a percentage of your company. It's the soft power and influence that comes from, sort of hopefully having the alignment and flexibility of an angel, but maybe like the gravitas, pardon the expression, the balls, of like, a VC in the marketplace who's willing to advocate on behalf of the founder to other investors, who's willing, to punch above our weight. I used to joke, I'm not as active on Twitter anymore, but I used to joke that like my ultimate FU was like, I have 250,000 followers on Twitter and no LPs, try me. It's like that if I had to go to, if I had to go to war on behalf of a founder, like you don't want to go to war with me type of thing. And so it's really that. I think it's the biggest difference of sort of in our mind, just trying to make sure that at the end of the day, you're helping a founder. I mean, I think my goal is just increase the probability and velocity of helping a founder build something that's in their head. And that's it. It's not the next markup. It's not, am I on the top 30 list of this or that or so on and so forth. It's not the personal brand content marketing. It's like, am I going to be buried with, company logos on my tombstone that were enduring great businesses that created value not just for their VCs and founders, but for employees and ultimately, retail investors. We had one of those hopefully a few weeks ago in Chime when they went public, and I think that company is going to have a massive success as a public company. And so like that's the fun, right? You start off sort of just it's like maybe the metaphor would be like rock climbing, like indoor rock climbing. You start at the base of this wall and you see that there's a bell up at top and you want to go ring the bell, and you really have to figure out where the footholds and toeholds are. And I think we've just gotten better and better at sort of knowing how to find those footholds and toeholds, on behalf of companies.
Incredible. Let's jump into what kicked this whole email thread and now podcast off, which is secondaries. Um, as of some data point recently, secondaries made up 71% of exits in 2024, which is huge. That's a massive shift from just a few years ago. What has made secondaries not common, more common, but like truly essential?
Yeah. And I mean, look, your audience is sophisticated enough to understand, but just to like baseline.
Uh,
So, secondaries are, somebody is selling, a share of a company that they already own, to another investor, to another party, either direct ownership of that or ownership of that at a future date. There's lots of different ways to financialize the transaction of equity, as opposed to the company itself issuing shares and selling them to investor and putting that money in the company treasury, right? That's called like, primary versus secondary. So the easiest way to think about it is somebody has invested a dollar in that company, but as opposed to that dollar going to the company, that dollar's gone to somebody else who holds shares in that company, whether it's a founder, a team member, a previous investor, whomever. Um, those would occur, those have always occurred, right? They've always occurred for different reasons, usually reasons of like, let's call them like distress or circumstance. A venture firm for some reason shuts down or decides it's not going to raise a next fund and has a bunch of legacy positions that they need to liquidate and stuff. And you used to have folks who would go and buy that entire bundle, right, at a discount to the book value because, they have to hold it for some period of time. And there are always different sort of, situations where, a co-founder needs liquidity and is trying to, sell some shares or things like that. I think early on in our existence, frankly, I wrote a blog post saying that like VCs had to get comfortable with should get comfortable with partial founder liquidity even earlier. Not, hey, take millions of dollars off the table in your Series A, but the idea that a lot of founders come from or had circumstances where like they might have obligations or financial needs that distract them from running the business. And if we can help them remove that distraction to focus only on the business, um, great, right? So like we helped, some early like, Series A secondary for founders to the tune of like, high five figure, low six digit figure in order to pay off student debt, in order to move out of a crowded 3 bedroom with two roommates in order to get a 1 bedroom so they could actually like sleep and work, buy an engagement ring. Like somebody once needed money to buy an engagement ring. I go, well, forget even that. Like like why don't we, the company will just give you a bonus. Like you're already paid so far below market as a CEO because you want to sort of set the right tone, so on and so forth. Like you've done great. Like we'll give you a performance bonus to go buy a ring, So I think you need to understand that like people are giving their lives over to these companies. And so it's not just about, sort of like investors getting rich. It's often about, real people's circumstances and making sure you're accommodating them. Now, of course, as you said, like that number, those set of circumstances don't get you to 71%, the
yeah.
number you quoted about VC exits. And so I think there's been some big shifts in the market as to why. And I'll, we can talk more about that. I can also talk specifically about like the checklist of three things that
Sure.
we go through when we're thinking about sort of an opportunity. But by and large it's influx of private capital and interest in owning shares in the best companies staying private longer, and so more opportunities to sell those shares to somebody other than the retail markets, and the bifurcation of the venture market into billion-dollar funds and sub $250 million funds who have different timelines, different underwriting objectives, and are playing different games. And so, as you shift shares from those early funds maybe to those later funds, that's another opportunity for secondary that before was, a little more uncommon.
Do you think long term, like, is this impact like a feature, or a blip, or is this like here to stay, or do you think we'll even see like more of it? Like, do we think we'll have more of like,
Oh
I think
yeah,
you
I,
commented that like VCs are not, they're investors, or now they're looking more and more like traders versus investors, and you're seeing VCs become IRAs and all this. Like, is this gonna become more common?
I think it's here to stay. I think
Yeah.
you already have, some of the largest funds, the multi-billion-dollar AUM shops. You're talking about doing everything from pre-seed investments to holding public company stocks. They have, essentially trading desks for crypto and other things that they are in and out of. They're running wealth management funds on the side. And so it'd be silly to think, that they don't have interest in capturing every part of the stack. Now, does that mean that, the GP, the board member GP who does the deal is also going to be, the one negotiating the potential secondary 6 years from now? No, it might be a different function within firms, but thinking about and judging liquidity, timelines to it is, of course, an important part of being an investor. And anyone who wants to be a VC, I always remind them, I'm like, look, there's lots of reasons to do it. But you can never, no matter what your reasons to do it are, you can't forget that you're an investment manager, and a salesperson. And so the investment management side, is where this all comes into play. So I think it's a feature. I think it's here. I don't think we're a year or two away from, say, like a frictionless marketplace where, anybody can log on and, buy or sell their shares. I think there's still going to be um, you know, different aspects to it that create frictions. Sometimes those frictions are positive, I think. Sometimes those frictions are negative. Positive frictions, are that, you can remain private and your company's not being like marked to a market every day,
Hmm.
so you can sort of, put your head down, do your business and structure your sales a little bit more as a, your fair sales as a CEO or board. But one of the frictions is you often end up with a cap table of people who are, misaligned in their needs or at different stages of the business can provide different value or don't provide as much value. Or as these companies pivot and change, the expert you might want to look for skin in the game expertise, and different types of investors than, the person who gave you some money 10 years ago provides. And so those things are all, ways to make sure that the uh, your shareholders and their incentives and their expertise are of, optimal value to the stage of the company and to the CEO and founders. And so that's all feature, when used appropriately.
How are you advising founders just to navigate this entire new kind of new world or reality where this is more and more common? Like, there's a lot I think to when as a founder that I think about, right? It's like, well, should I take secondary? You mentioned some of the reasons earlier on from like 2014, the engagement ring scenario in that sense, but like maybe there's other new scenarios. Like, how do you advise them to think about like selling their own shares? How do
Yeah.
I facilitate the conversation between investors where I have Hunter's been on the cap table for 12 years. He's looking to liquidate some of his capital versus this. Like, how do you just provide
Yeah.
counsel to the founders with all of this?
Yeah, it's dynamic, right? So I think there's different ways, you know, there's questions when looking at oneself, as a founder, there's always questions about um, what sort of options are being presented to me for full or partial liquidity in the near term, and do I feel better, you know, if my interest in liquidity um, is uh, greater than if I think there's more value to be created in the business, but I need some liquidity, I want to be able to focus on creating that value in the business, not prematurely transacting the company just to deliver, liquidity to common, right? And
Mm-hmm.
so in that case, figure out ways to almost take off exit pressure by taking money off the table. In some ways, that's like not believing in the future. It's believing so much in the future that you don't want to sell 100% of your stake right now. Um, uh, and uh, y- venture investors have a portfolio, founders and many employees, but certainly founders traditionally have the vast majority of their net worth, tied up in a company per se, or potential net worth. And so I think it makes prudent sense to think about how to incrementally um, diversify to allow yourself to focus on the company. And, there might be, I think it's too blunt a statement and not true just to say, about the founder side or on the investor side, well, if you're selling, that must mean you're not believing or you're signaling something bad, or what does that person know that I don't know? There's all sorts of reasons why. I do think as a founder or executive team, you sort of get like one or two bites at that apple before you have to think about it at a company level. I think it's bad practice and you give up some of your moral authority if you and or like favored investors are consistently taking money off the table and you're not giving similar types of access to common. Joining an early stage startup is really irrational. And so those people should be rewarded, ahead of the full timeline to, an IPO or liquidity if that's taking a while, I believe. But again, doing it in a structured fashion always makes sense, whether it's with company capital, whether it's directly to other investors. I'd always say founders should maintain control, right? So like documents will often, companies will often need to sign off on these things. They don't have to provide, information rights or other types of things to investors. Like you definitely don't want secondary processes to leave you with cap tables that are worse off than you'd have if you hadn't gone down that road. Um, but I think there's more, there's more and more, uh, every lawyer has now done some secondaries, right? So it's like pretty easy. Um, on the investor side, I think it's always sort of like just like you are kind of ahead of a financing or as financings, you're probably also always checking in with your investors to be like, hey, we're heading towards this next round. How are you thinking about your pro rata? I think there's sort of a similar conversation, which is sort of like maybe we can call secondary like anti pro rata, in the
Yeah.
sense of, hey, if you're not a buyer, are you a seller? Right.
Mm,
And like it's not an inappropriate question to ask. I think if anything, being in business with your VCs, you don't work for them, they don't work for you. They're your business partners. And so asking your business partners, how are they thinking about, the shares they hold, over, the period of the next few quarters, I just think is the responsible thing to do. And it gives you the best sense of, maybe um uh, you know, who might create some flexibility for you versus, who's ride or die for better or for worse. And I don't think, don't think those should be hard conversations to have. And maybe at this, maybe they're for your CFO to do, like you can sort of
mm,
divide up, hey, this is just something, this is on a checklist. We're a big company now. We're sort of formalizing understanding. I'm asking everybody these sets of things because I want to know if things come up, that type of stuff. Um, and so, yeah, I sort of think it's like, at any financing or approaching any financing, I think it's always good to uh, run through your sort of investor list and either directly or indirectly figure out who you think might be a buyer and who you think might be a seller.
right.
That gives you a best sense of demand and like the puzzle pieces to work with. I can tell you from a fund perspective, how we think about that. But I want to, give you the chance to push
Yeah.
on any
No,
of
let's
those
do it. Let's jump
things
in there.
or
Like, how do you think about it from at the fund level? Let's go right there.
yeah. Okay. So I think, we've done this a little bit along the way. I think it's been to the benefit of the companies we've been in, the benefit certainly to our fund and our LPs. When we started thinking about this, you end up owning, as a lead investor, you own 10 to 15% of these companies. And when they start ripping, you sort of have this question, right? And Satya, my business partner who had done venture before, sort of came up with sort of like this, like three questions we'd ask ourselves at each financing round after the B type of thing. One was like, and it was essentially just to get to the answer: are we buyers or sellers? That doesn't mean we were going to buy or sell, but it sort of gave us an opinion about whether we'd be buyers or sellers. And the three questions we asked ourselves are: valuation to progress. How far out over, how far into the future is this new investor paying for performance? Is it 12 months? Is it 18 months? Is it 36 months? Or are they, is this so far out into the future that you'd really have to believe that this company is, let's call it priced to perfection right now? The second is based upon the not just the terms of the round, but based upon who the investor is and the structure around it and the rest of the cap table. What sort of alignment do we believe there is amongst the investors? As more and more later stage investors come in, do we believe that their needs, goals, and the way they think about this investment, how consistent or inconsistent is that with the way that we think about the investment? So, you'll often see folks who might be underwriting to a different target, who might need liquidity at a different time frame, who might have strategic or other purposes for their investment beyond just absolute return of capital. And as an earlier and earlier, smaller shareholder, we rely not just on voting thresholds and CC council on emails. What you hope is that you just have everybody sort of financially aligned. And then the third aspect is probably the most sort of like personal each fund manager, which is sort of like your fund management and your portfolio management. Depending on where you are in your own fund cycle, um, how important is it to you and your investors for you to potentially distribute some capital? uh, as a smaller fund, there's always more opportunities, always more surplus of pro rata opportunities. Where are you going to put that capital? We might believe quite enthusiastically in one of our portfolio companies, that's further along. but believe that they just did such a great Series C, at a $2.5 billion valuation. We might believe that there's, incredible upside from there. They might be worth $5 billion, but right. But essentially, that is a 2x from there, right?
Hmm.
If we believe that we have a company that, is doing $100 million Series A that has the potential to be $1 billion company, if we could get another dollar into that company, that would be a 10x turn on that dollar. So sometimes we're thinking about it purely from a cash flow and optimization. How do we continue to recycle to get past 100% invested in order to keep getting turns on those dollars? And so the short answer is like when enough of those things came into play, where we said, look, we believe this company is richly valued. We believe that there's starting to be a mix of investors with sort of different goals, different expertise, different types of structure, and that we could put this dollar to use and or return it to our investors in a way that would be productive for them. Maybe we should start looking at selling a portion. Maybe we should take some money off the table. The last question we always asked ourselves on some of these things was a purely emotional one, which was, if we sell 10% of our ownership and it doubles from here, the company's valuation doubles from here. Are we sad we sold 10%, or are we happy it doubled? Right.
Hmm.
And at the point at which you're like, oh no, I'd be happy, like, actually, even though it, might not be might be a quote unquote regretted transaction in the sense of we sold below its current value. It's like once you get past the idea that you're never going to perfectly time the market in terms of getting in or getting out, but in aggregate, you're going to make good decisions. Hopefully, from uh, positions of strength and frameworks that make sense to you, as opposed to out of pressure from your investors, out of fear of what happens from here, or out of greed of I don't want to I don't want to sell if this company keeps going up. Like all those things factored in, but that was our checklist. And sometimes we availed ourselves of in a company like Chime, incrementally taking some money off the table along the way, and other places we decided to hold, even though we would have, and still have consistent, inbound from other investors and other market makers on some of our positions.
Where does the founder relationship fit into that checklist too, right? Like, let's say this is checking some of my boxes, but you have a very strong relationship with the founder, and you don't want to cede ownership. Like, where does that fit into the matrix?
I would say like, the friendliest way to do it is they are interested, they have investor demand um, from either current or new investors who really only make sense if those investors can get, to an ownership target, and allowing them to transact, shares from another investor actually prevents dilution for the company. And so in those cases, like the flexibility to somehow sometimes put our shares back into the pool, so to speak, was quite helpful. I believe we did all our Chime secondaries as part of structured financings, where alongside the company raising capital. So it was always to another existing investor who wanted to own more, either as a new investor or existing investor. And so in those cases, like you're actually helping the founder, right? Like
Mhm.
and solving a liquidity, a type of liquidity problem. Um, in cases where, let's say, it would be more fractured or contentious, I think it goes back to sort of uh, like two things. One, can you have a conversation as business partners and figure out like, hey, here's what I'm thinking. Is this something you can help me with, either creating demand, or I have some demand, how would you feel about, you know, me going down this path, finding out who the buyer might be, so on and so forth. Um, uh, or, the second question is, um, you know, the first, I think the cardinal rule, which is like do no harm,
Mhm.
right? So, um, ultimately, if you can't find a solution, unless you believe that that company has has or is doing things that imperil your position as an investor, in which case I think that sort of breaks some of the contracts, so to speak, in the sense of you now have a fiduciary, to your LPs to figure out, well, what do I, what do I want to do with this ownership? I think at the end of the day, it's a business partner to business partner conversation with a do no harm backstop.
Yep. Okay. I love it. Um, we got. I want to make sure I'm respectful of your time, and I want to switch to Screendoor as well, because I think that can have some interesting pulls in this conversation. First of all, like, what is Screendoor, and what led
Oh,
you
sure.
and a team of other notable VCs to start it?
Yeah, thanks for asking. So, um, Screendoor is a fund of funds, which means we use capital to back VCs instead of startups. I like to say I get to invest in founders who start companies via Homebrew and founders who start venture funds via Screendoor. We began it in 2021 using with myself, Satya, folks like Kirsten Green from Forerunner, Charles Hudson from Precursor, um, using capital from primarily our LPs, endowments, foundations, folks who wanted uh, access to early stage emerging managers, fund ones, let's say it,
Hmm.
but knew that based upon the check sizes they write, traditionally large, their underwriting process, traditionally lengthy, and their sort of general connection to the ecosystem, which is largely established funds, entrenched players, knew that they wanted to both capture the alpha from some of these high performing early funds from people they didn't know and also build relationships to potentially go direct into those funds as they grew. And so we created a structure that allowed them to do so. We raised $95 million and then would underwrite, about 10% of a new emerging managers fund. So somebody's trying to raise $40 million, we would do 4 million of it, so on and so forth. The reason we started it, I guess I'd say for me personally, was a little bit of like, let's call it love in my heart and chip on my shoulder. The love in my heart was as Satya, myself, and some of our peers got further and further into the building of our own firms, we found ourselves being solicited for advice and, frankly, also personal investment by these next generations of emerging managers who, perfectly A plus players on their own, but knew that if they had access to people who maybe had, a lap or two under their belt, could come to us for advice, questions, that type of stuff. And so we were enjoying it. The love in our heart is like, I enjoy this. And I think that there's a market need for a product like Screendoor. The chip on my shoulder is, um, I believe, like Darwin moves too slowly in venture for reasons of time cycles, incentives, so on and so forth. We don't purge mediocrity from the venture ecosystem fast enough. And so, I was a history major, not a science major, but I did remember enough about, biology to know that if, one aspect of Darwin is new competitive species in the ecosystem. And so maybe as opposed to homebrew becoming, this big thing, which we never wanted it to be, maybe we can help dozens of other competitive species get into the ecosystem faster to chew up and spit out the existing mediocrity from the system, or at least maybe cause some early wealth effect retirements amongst the last generation of venture partners who don't want to compete with these new firms. So that's why we did it. We're now investing out of a second fund, a successor fund. It has a full-time team of three. All of the people I named are still very involved. In addition to, we keep on recruiting new VCs to be mentors, advisors, so on and so forth. But it's been a joy, and we've backed over 25 emerging managers, so I get a perspective very much so on the ecosystem. I think we've reviewed probably approaching 2,000 firm submissions, and so. It's a great way for me, I guess, to make an impact upon the ecosystem, to stay connected to this next generation of investors. The learning is very much bi-directional. And as you might expect, like secondaries are a big topic amongst this group
Mm.
as well.
And yeah, I'm curious. Like, I got kind of two follow-up questions. So one is, you are an LP in these new funds via Screendoor, while you are yourself not raising external capital. Like, how does that dichotomy work together, right? Because it is a little different.
Yeah,
And like,
it's
how are
actually
you
really
investing?
great.
Yeah.
It's really great because Satya and I really loved our LPs and enjoyed the LP ecosystem in general. So working with a lot of these folks via Screendoor allows us to stay connected to the capital ecosystem, even if we are, as a firm, are no longer dependent on it. The second thing to note is this is not a scout system. This is not a feeder system, right? So Homebrew, Forerunner, Precursor, these firms that have GPs who are involved with Screendoor are not getting access to the underlying quarterly reports, documents, so on and so forth from
Mm.
the firms that we back. Of course, there's strong relationships, informal collaboration. I mean, I think you want to work with, people and so I'd say there's obviously a benefit that goes both ways. But there's never been this question about, well, if I take an investment from Screendoor, what does that mean? Where does my data go, right?
Sure.
And so, you know, uh, the the way I think about it is I get to spend, like I said, I get to advise founders. Some of them just happen to be founders of venture funds as opposed to founders of startups.
Yeah. Um, Talk about secondaries. How has that kind of influenced the chatter that's happening within the Screendoor community and
Yeah,
your relationships?
it,
Like, how's it influenced
I
it?
think I think there's two things. One, it's a group that's very interested in availing them in understanding it, um, because by almost definition, you have when you raise a fund, you have a spreadsheet that you've worked out that says this is how much I need to raise, right? It's this number of investments for this ownership, this check size. And then what's the old Mike Tyson quote? Everybody has a plan till they get punched in the face. Then you hit the market. And you're trying to figure out, okay, oh, well, what if I have to pay a little bit more for this? Basically, the short summary is your fund is never the right size. It's always, too big or too small. We try to tell people don't raise funds that you know are going to be too big. Those just create headaches. So keep a correct fund size, and then recycle. Continue to put money into your best investments. And so the idea of out of both opportunity and sometimes necessity, if you're a first time fund manager, maybe you don't yet have the wherewithal to raise an opportunity fund, maybe you don't yet have the LP connections to spin up SPVs to do your pro rata stuff like that. Folks look at secondaries as opportunities to uh, uh, manage early liquidity in ways that will help them navigate the complexity of a sub $100 million fund in most cases, and a deployment period and spreadsheet that when they made 3 years ago no longer matches the reality on the market. So that's the practical application. I think then there's the theoretical one, which is, you know, if you're a first-time fund manager, and some of we, I say we back diamonds and diamonds in the rough, right? So sometimes that's people who are new to venture, sometimes it's people spinning out of the Sequoias of the world, so on and so forth. A lot of those people, you know, were not exposed to the back office, the CFO function, this level of detail. So even if they come from um, a professional investing background, secondaries is sort of still this black box. We all, we talked a little bit and spent most of the time here talking about let's call it the friendliest, most traditional kind, which
Yeah,
is, I sell from one existing investor in the company to a new investor in the company with the blessing of the CEO and everybody involved. There's all different other types of things that people are doing, right? Like forward sales, secondary, tertiary exposure. People are, financializing their ownership in an SPV to sell that to other. I mean, and so some of these things are complex. Some of these things aren't worth the trouble. But I think they want to understand, because not just for their own benefit, but they start to see these things show up on the cap tables of companies they're involved with, and so they want to understand, well, what's going on at this party, right? It's almost like if you're in a room, at a cocktail party, and you're standing in a corner and you're having a very nice conversation with other people who you're familiar with, and you see that there's something going on across the room with a bunch of people who look nothing like you, and it seems to be a very loud conversation. You're sort of curious what's going on. That's kind of
yeah,
a new manager and the secondary ecosystem, right? So we can be a bridge to that, both in terms of explanatory, but also frankly in terms of relationships, introductions, and experience.
cool. Love it. Two questions before we wrap up. So one, you've been on both sides of the fundraising table, with raising capital, now deploying it into companies and into LPs. What advice do you give to like emerging GPs
Yeah.
about building LP relationships that ultimately last?
Yeah. Well, I'd say two things. One, you have to treat it like a sales funnel, which is basically to say, prioritize the people who you think you can get to a decision, people who want to build relationships or, waste your time. It doesn't mean they're bad actors or anything like that. It just means, don't, um, uh, better to get to a fast no than a slow no, right?
Mhm.
I think in this business, and then you figure out how to drip the information to them for your next fund. The second is I tell every manager, look, the way that I think about it right now is a lot of LPs don't necessarily want or need new venture exposure. They've been sitting on a bunch of illiquid positions. Thankfully we have things like the Figma IPO, so on and so forth, starting to free stuff up. So you have to prove that you are either similar but better. Like they understand what you are. You're doing something that looks very traditional, but you're doing it better than the last generation of folks. They should trade out one of those cards for you, or you are different and excellent. You're providing them exposure to a part of the asset class that they don't currently have. exposure to through their existing portfolio. So essentially, you want them to draw another card from the deck, add another card to their hand without, without necessarily having to replace a card.
Yeah.
If you don't have one of those two stories, you're not going to raise.
Mm-hmm. Last question. The theme of this season in our podcast is all about relationships, given just in everything we've talked about today too. Curious on like what's one relationship that's changed your life?
I mean, God, I could have, I mentioned him briefly, but it's my partner at Homebrew, Satya Patel. Like we exist as Homebrew because from the early to mid 2000s, he and I sat 3 to 5 feet from one another on the same team at Google. He left at the beginning of '07 to go back to venture for a bit before running product at Twitter. I stayed on around product at YouTube. When he left, obviously there were plenty of smart people at Google at that time. When some of them left, you wanted to stay in touch, or you kind of said like, oh, it'd be cool if we found ourselves, doing something, like at the same company or whatever. People were going to Meta, whatever. Like maybe we'll both be a Meta. He and I, there was just something weird. I was like, we're going to do something one day, and I'm not sure like why I feel this way or what it is, but I think it's going to happen. And it just turns out we needed a blank sheet of paper. It wasn't one of us trying to convince the other person to come do something with them. It was, hey, do we want to spend the rest of our lives together? And if so, why and under what circumstances? And without that, maybe you and I would still be talking, but we'd be talking about something very different than
Mhm.
homebrew.
Yeah, I love it. Well, Hunter, thank you so much for spending your time with us today and kind of giving us your amazing takes across the ecosystem of everything you've
Oh,
built and everything that
of
you've done
course.
for Founder. So thanks so much for joining us, and we'll see you on
Yeah.
LinkedIn.
Perfect. Yeah. Yeah. 875,001.
There we go. Awesome. Talk to you soon.
Thanks.